Chapter 1, Managerial Economics and Decision Making. So we have a set of learning objectives. For this chapter, we're going to describe managerial economics. We're going to look at the different ways that firms are set up. We're going to explore this topic called opportunity cost and how it differs from accounting costs. And then another topic, marginal analysis, and how that can be used in decision making. Managerial economics, we're applying microeconomic principles and tools to business problems faced by decision makers. So the potential is that it's going to inform how to manage firms more effectively. So that would mean making better decisions, and then we'll also look at how the economy plays a role in these core decisions that need to be made by firms. So a firm is something that takes inputs, such as labour, and converts it into outputs. That might be something physical, like a good, might be something like a service, and then that is sold on, distributed. Maybe it's sold to an end user, maybe it's sold to an intermediary. And then there are different ways that firms are organised, and we're going to talk about some of the advantages of these. So there's a sole proprietorship, that's just you by yourself owning the firm. Of course, when it's just you, that makes it easy to organise those decisions. Profits are taxed just once. Disadvantages, there's unlimited liability, so if something goes wrong, then that means that you're liable. You're liable as the business owner, but also they could come for your assets. And it's limited life. So once you're gone, then the firm would potentially go. So it could be things like taxi owner operators, sole practitioners, restaurants, things like that. Partnership, as the name suggests, there's more than one person owning the firm. You might motivate people by offering them to become partners. You have to register the firm. There's unlimited liability again, but there can be some ways to modify that. And an example might be a partnership with a law firm or a medical practice. And it's quite common to see small numbers of partners running those types of establishments. Limited liability corporations, or LLCs, so owned by one or more members. This is a very popular structure because of that limited liability. So the limited liability means that you're afforded some measure of protection of your personal assets from being taken if something were to go wrong. And so we have some examples there. LLCs such as Mac Construction, Edgeworth. And then there's a corporation, and that can be owned by one or more shareholders. And then there's a bit more of a separation expected here between the owners and then the people that are running the business. So there could be cases where the shareholders are entitled to some of the profits of the firms, but they might be quite detached from the day-to-day running. Not always the case, but often the case. So the firm will continue after one of those shareholders passes away, and there's limited liability. But it does bring some disadvantages, such as required registration. Profits can be taxed twice, so the corporate income tax on profits and then personal income tax on the shareholders' income, such as your dividends. And then obviously some very familiar company names there, Pfizer, Microsoft, and Ford. So we're going to assume that the goal is to maximize profits. And the profit is going to be the difference between total revenue, that's money in, and total cost. So we want that gap between total revenue and total cost to be as wide as it can be. So we're going to assume this profit maximization goal for all for-profit firms. There are some other strategies there. There can be not-for-profit firms, NGOs. They might be less motivated by profit, but might still need to maximize what they get out of their resources. So for total revenue, this is going to be important. We've got price times quantity. So how many units we sell and how much each one sells for. So that product is total revenue. And obviously there can be some things that cloud this, such as discounts, rebates, returns, allowances, etc. On the cost side of things, there's accounting costs, and these tend to be what we call explicit costs. So these are costs that have some bearing on the outflow of the business. You can think of an explicit cost. Somebody's had to open the wallet, write a check, transferred some money for. It could also include depreciation of assets, so assets that last over a number of years can write down the cost of that asset incrementally. On economics, we have a very broad version of costs. Now we have something called opportunity cost. And an opportunity cost is the return from the best alternative use of a resource. And we're going to spend a little bit of time on this. So it's a measure of what the firm gives up when they use that resource. And it also includes these explicit costs that we've mentioned. And then also the implicit costs. Costs incurred by running a business that maybe didn't involve an outflow. And we're going to see some examples of this in the next few slides. So I'll just spend another second on this. So accounting costs are generally explicit costs. And it may include the depreciation of assets. Opportunity cost is a broader view of cost. And it includes some of these things that we've given up when something's been used in running the business. So accountants, they've got particular procedures, last in, first out, first in, first out, LIFO, FIFO, for example. Economists value things based on opportunity costs. So the value of the good could be the item based on its market value. If that market value is not available, then somebody needs to assign one. And then a sunk cost does not matter in an item valuation. So sunk costs, we'll see that a little bit later in the course material, but that is a sunk cost that's gone and can't be recovered.